One of the most famous critics on Wall Street just said the biggest corporate bet on Bitcoin in history can only end one way: bankruptcy. And this week, a law firm investigation handed him fresh ammunition. So, is the company that bet everything on Bitcoin actually about to collapse? Let's look at what's really going on, because the truth is more complicated and more dangerous than either side wants to admit. The company is called Strategy. You might still know it by its old name, MicroStrategy. And to understand why this moment matters, you have to understand how strange this company's journey has been. For most of its life, MicroStrategy was a dull, unglamorous software firm. It sold business analytics tools. It survived the dot-com crash. It survived an accounting scandal in the early 2000s. And for 2 decades, almost nobody outside of enterprise software had any reason to think about it. It was the definition of a forgettable stock. Then, in 2020, its founder and CEO, Michael Saylor, made a decision that turned it into the most talked about company on the market. Sitting on a pile of cash that was quietly losing value to inflation, Saylor decided the company would convert that cash into Bitcoin. Not a small position, not a hedge. He decided Bitcoin would become the company's primary treasury reserve asset. And once he started, he didn't stop. He bought with the company's own cash. Then he started borrowing to buy more. Then he began issuing new shares to buy even more. By the middle of 2026, Strategy was sitting on more than 840,000 Bitcoin, acquired for over $64 billion. It is by an enormous margin the largest corporate Bitcoin holder on the planet. No other public company is even close. The business had transformed into something the world had never really seen before. A giant publicly traded pile of Bitcoin with a software company still humming quietly in the background. Now, here is why, for a long time, this looked like pure genius. When you buy a stock like Strategy, you are not really buying a software business anymore. You are buying exposure to Bitcoin, but not one-to-one exposure. Because Saylor was funding those purchases with borrowed money and freshly printed shares. The stock behaved like Bitcoin with the volume turned up. When Bitcoin rose 10%, Strategy could rise 20 or 30. It was Bitcoin on leverage, wrapped in a stock you could buy in any ordinary brokerage account, even inside a retirement fund. For investors who wanted an amplified bet on crypto without ever touching an exchange or a digital wallet, it was the perfect vehicle. And this created something powerful: a flywheel. The stock traded far above the value of the Bitcoin it actually held. That premium let Saylor sell new shares at inflated prices, use the money to buy more Bitcoin, which pushed the story further, which lifted the stock, which let him sell more shares again. Around and around it went. For years, that flywheel spun beautifully. The stock soared. Saylor became a hero to the Bitcoin faithful, giving speeches, coining slogans, promising the company would hold its Bitcoin forever. But leverage is a machine that runs in both directions. The exact same borrowing that supercharges your gains on the way up can crush you on the way down. And that is precisely the fear that has now arrived. Enter Peter Schiff, one of the loudest, most persistent Bitcoin skeptics alive. Schiff has been circling this company for years, and this week he went further than he ever has. He called Strategy a death spiral and said, in his own words, it can only end in the bankruptcy of the company. His argument is not complicated. Strategy owes billions of dollars to the people it borrowed from. Its convertible debt sits at over $8 billion. That debt was cheap and easy to raise when everyone was euphoric, but debt has to be honored. And Schiff's claim is that if Bitcoin falls far enough and stays there, the value underpinning that debt erodes, the premium on the stock evaporates, the company can no longer raise easy money, and the whole flywheel starts spinning in reverse. And this time, Schiff wasn't only talking. The Rosen law firm has opened an investigation into Strategy on behalf of shareholders, examining whether the company misled investors about its business and its risks. Now, an important note here, and it's the kind of thing this channel will always be straight with you about. A class action investigation is not a verdict. It is not proof of any wrongdoing. Many of these probes are opened and quietly go nowhere. But for a company whose entire value rests on investor confidence, the timing could hardly be worse. Schiff seized on it immediately, arguing that Saylor, as chairman, is held to a higher standard of accountability, and that lawsuits like this are how these stories start to unravel. Then came the detail that made even neutral observers sit up. For years, Saylor's rule had been treated as sacred by his followers. Never sell the Bitcoin. Buy, hold, and hold forever, no matter what the price does. It was practically a religion. But at the end of June, the company quietly filed a new capital framework that authorized the potential sale of up to $1.25 billion worth of its Bitcoin to help fund dividend payments and share buybacks. Read the fine print, and it's just prudent flexibility, but read the symbolism, and it's enormous. The company, built on the promise that it would never ever sell, had just given itself formal permission to sell. To the critics, that was the first visible crack in the foundation. And it came alongside another warning sign. One of Strategy's preferred stocks, a security that was supposed to trade around $100, had slipped below that starting value. The people who lent the company money through these instruments were, for the first time, getting nervous. So is Schiff right? Is this the beginning of the end? Here is where we have to be honest, because the doom story runs into a serious problem. The people who actually sit down and analyze the balance sheet are far calmer than the headlines. Strategy's debt is not a stack of loans that a bank can call in tomorrow morning. Much of it is long-dated, convertible notes spread out over several years, and critically without the kind of margin calls that would force an immediate fire sale of Bitcoin the moment the price dips. This is the key difference between Strategy and the traders who blew up in past crypto crashes. Those traders were leveraged in a way that forced them to sell at the worst possible moment. Strategy, for the most part, is not. Analysts covering the company have repeatedly pointed out that it faces no forced selling and no near-term solvency crisis. Even with Bitcoin well off its highs, and even with the stock beaten down near $80, the company can keep meeting its obligations. Saylor himself has reaffirmed over and over that the long-term commitment has not changed. So, both extremes are wrong. This is not a company that gets wiped out next Tuesday. But it is also very clearly not the invincible money machine its fans believed in during the boom years. The real story sits in the uncomfortable middle, and that middle is where the truth usually lives. Strategy is, at its core, a leveraged bet on a wildly volatile asset. And the market is finally soberly pricing in what that actually means. That enormous premium investors once happily paid, far above the value of the Bitcoin the company holds, has been steadily shrinking. The magic that let the flywheel spin is fading. The stock is no longer trading on pure belief. It is trading on math. And math is a lot less forgiving than faith. And this is exactly why the whole saga matters, even if you never buy a single share of this company. Strategy has become the most visible symbol of a much bigger idea that swept through corporate finance. Seeing Saylor's early success, dozens of other companies copied the playbook, loading their own balance sheets with Bitcoin and other cryptocurrencies, some of them businesses that had no real reason to be crypto funds at all. A whole category of so-called Bitcoin treasury companies sprang up. And here's the thing. If the biggest, most sophisticated, most famous of them all is under this much pressure and being dragged toward a courtroom, then every single copycat is watching nervously, and so is every regulator. What happens to Strategy could set the tone for an entire experiment in how public companies use their balance sheets. It could decide whether this was a brilliant new model or a bubble that a lot of ordinary shareholders get caught inside of. So, no, Peter Schiff has not been proven right. Not yet. The bankruptcy call remains a prediction, not a fact, and the actual numbers do not support an imminent collapse. But it would be a mistake to dismiss him entirely, because he has put his finger on something real. A company that swore it would never sell just admitted in writing that it might. A stock that once floated on pure conviction is now being weighed on a scale. And a story that everyone assumed only ever moved in one direction, straight up, is finally, painfully being tested on the way down. The next year is going to tell us which version of this story was true. If you want the business stories that actually matter, explain straight, before they blow up, subscribe. I'll see you in the next one.